Good afternoon, everybody, and welcome to the final Service Department News webinar of the year. And today we are going to be looking ahead at some trends which we here at Service Department News think are going to resonate through the Service Department and extended stay market next year and beyond. My name's George Sell. I'm Editor-in-Chief at International Hospitality Media, and we are a publisher of online B2B news websites for the hospitality industry, as well as an organizer of conferences and award schemes. Today's webinar is going to last roughly 45 minutes, and we're going to talk about 6 trends today. I'm going to present 3 of them, and we'll have 3 Q&As with experts in their fields. The first Q&A is with Andrew Harrington of AHV Associates about green finance, and he actually can't stay for the entire duration today. So if you do have questions for him, please get them in quickly while we're chatting. There'll be a recording of the session sent via email to everybody who's registered. Now, the Service Department News webinar series has been sponsored by IMS. You can see their contact details in the chat and on the screen there. And we're just going to see a quick video to find out more about them. So thanks to IMS for sponsoring the series, and today's session is sponsored by AHV Associates. AHV is an investment banking boutique established in 2001 and focused on the hospitality industry. It provides advice on mergers and acquisitions and capital raising. It also publishes a monthly analysis of recent activity in the hospitality industry and an in-depth piece of research every 6 months. You can find out how to contact the guys at AHV in the chat. And also Andrew, partner at AHV, is on the session today. So thanks to them. As I said, we're going to have Q&As with 3 contributors throughout the session. And you can see them on the screen there, but I'm going to ask them to introduce themselves at the start of their particular segments. But you'll be able to see all their LinkedIn profiles in the chat. So please do get in touch with them. And we will get on with our first trend. So this is new opco, propco players across extended stay. So the extended stay sector on both sides of the pond is bucking what is perhaps the most significant trend in the entire hospitality industry of the last 20 years, and that's the wholesale adoption of the asset-light model. While going asset-light offers operating companies more scale for rapid growth, an increasing number of major players are betting on the strategic advantages and synergies that come with having opco and propco under the same ownership, and importantly, with an aligned vision. In the US, Blackstone and Starwood Capital's $6 billion acquisition of Extended Stay America sent out a statement. ESA owns the majority of its 650 or so hotels, making it, to my knowledge, the biggest owner-operator in the world. it's now primed for serious growth, with CEO Bruce Haas talking about up to 1,000 properties. And its new co-owner Blackstone is continuing its acquisition spree in the space too, with the recent addition of the 15-strong Condor Hospitality Trust portfolio. Condor is a real estate investment trust, a REIT, and there are other growing REIT players in the extended stay space, such as Sandpiper, which is steadily acquiring hotels, and its management arm in many cases is operating those. Last year's Service Properties Trust, a major owner of extended stay hotels in the US, which has a significant stake in hotel company Sonesta, made some serious waves when it switched more than 200 properties, which were badged under various IHG and Marriott extended stay flags, to the Sonesta Suites brand. And here in Europe, we've seen Brookfield and Eden showing the benefits of aligned ownership, with the Lock brand opening an impressive 6 properties in 2021 and having an even stronger pipeline for next year. Dutch pension fund APG is also getting in on the act and is acquiring properties for Amsterdam-based City ID and London-based The Other House to operate. And just last week, Fortress Investment Group acquired a majority stake in Dublin-based Prem Group. And I suspect that part of the attraction of the deal was that Prem owns a significant number of the 38 service department and hotel properties it manages. Now, I don't expect the likes of Marriott and Hilton to suddenly go on an asset shopping spree, but over the last 2 years, when landlord and tenant relationships have been tested like never before, the extended stay space is leading the way when it comes to exploiting the numerous benefits of a close alignment between owner and operator, a trend I expect to gain momentum next year. So, on the subject of finance, specifically green finance now, we'll move on to our next trend, and we're going to have a 10 to 15 minute Q&A with Andrew. So Andrew, I know at AHV Associates you've done quite a lot of work into this subject recently. Can you give us a snapshot of the green finance picture in the broader hospitality sector?
Yeah, sure, George. Thanks a lot for having me on here. You've already got a background on who we are and from George earlier, so I won't go into that. In terms of green finance generally, you know, the whole thing started in 2007 with a green finance offering from the World Bank, and that really nobody really understood precisely what it meant, except it made everybody feel good at the time. And since then, it has expanded a lot. Although up until a couple of years ago, really, it wasn't really defined exactly what was meant by green finance. There were no standard ways of looking at it from a finance perspective. And the main issue is with the World Bank and the EIB, et cetera. And then we had some standards set by the Loan Market Association, the International Capital Markets Association, which meant that green finance couldn't be whatever people thought that it was, or whatever people decided it was at the time. And that really triggered quite a lot of new issuances in green finance, where the greenness there was a means of verifying what projects it was being spent on, et cetera. Now, hospitality was fairly late to the party. The first hospitality-based green bond that we can identify was Pestana, which is a Portuguese hotel group who raised 60 million euros a couple of years ago. But since then, we've had Whitbread bond, of course, earlier on in the year, which was a major bond, £550 million in 2 tranches. Accor, Accor last month did a €700 million green bond, and these were all consistent with the ICMA, the International Capital Markets Association, guidelines as to what constitutes green finance. We've also had some loans, some high-profile loans, like the HSBC loan to the Londoner, the Ariel Bank loan to the Dorset Hotel. We haven't got an insight into what precisely those loans were being used for and how they're categorized green, but they will be subject to the LMA guidelines. So the bottom line is, George, it's starting to really accelerate now in a verifiable way. And that's the key point, right? In a verifiable way. And it's no longer really whatever people want it to be. And I guess the final sort of piece of information here that's really important is that there is quite a lot of evidence that green finance is cheaper than regular finance. Estimates vary. 15, 25 basis points is a sort of argument that a lot of finance academics, not argument, excuse me, analysis that a lot of finance academics have come up with in terms of the discount. There's some evidence that hospitality premium, as it's called, the lower borrowing costs higher for hospitality, and that would make sense, wouldn't it? Because hospitality is usually exposed to the ESG phenomenon, and then the reason why is because end user, at the end of the day, demand comes from consumers. It might come from consumers traveling somewhere and wanting to stay in a hotel and wanting something that's green, or it comes from corporates whose customers demand that they adhere to ESG, the ESG agenda in terms of where their people stay. So on the revenue line, it's very, very exposed to consumer sentiment.
Yeah.
And on the cost line, in the real estate sector, certainly, hospitality is the most energy intensive of all the different sectors in real estate. So, and hence, if you're able to cut costs because of the use of solar or whatever, then it has a big effect on the P&L. So there's a lot of reasons why hospitality would be more exposed to the ESG agenda than other sectors. And that seems to be coming through in the cost of green finance, although the green finance market is not a huge part of the hospitality finance market right now, although it is increasing sharply.
Yeah, yeah. We'll talk a bit more about corporate ESG requirements later on with Joe, but can you tell us a little bit, Andrew, about the criteria that projects or companies need to meet to be to access green finance, which has been verified by the organisations that you mentioned earlier?
Yeah, I mean, look, I mean, on the it has to adhere to certain construction codes, doesn't it? I mean, BREEAM, excellent, BREEAM, very good. There's a whole variety of these things. They've all been around for like many, many, many years. It's only really relatively recently that the providers of finance have been focused on them. So you've got to be BREEAM excellent or BREEAM very good. There's no question about that. But it's in terms of new construction. But it's more than that now. It is more than that. It is, how do you treat your staff? Is your staff diverse? Do you give back to the community? All these are softer elements that are very important. And what we'll find, and what we are finding for sure, is that those who do it well will do very well. They will market their ESG credentials. They will get higher ADRs, higher occupancies, lower borrowing costs, lower yields. It really is a virtuous circle. We've called it the opportunity of the horizon, in hospitality, because hospitality is so exposed. So it's a mixture of lots of things, George. Adherence to the standards, to the ESG building standards, absolutely, for sure. But it's more than that as well. And the more than that bit is a lot softer than just adhering to the building standards.
Yeah, yeah. And you mentioned some existing deals among hotel companies earlier. But are there any examples of companies in the service department or extended stay sector securing finance or investment as either as a direct or a tangential result of their sustainability credentials?
There's been no landmark publicised deals, but certainly beyond Apart Hotels, which is a company founded by James Fry, who was really a pioneer in this space in Switzerland over the last 10 years. He's been able to raise some finance from Vengrove, it's a private equity company, and he is certainly expanding a lot. Room 2 itself, now Room 2 is owned by family, and does not have to publish any information at all on where their financing comes from. But they are, again, with Beyond, they're very much a pioneer in this space, and they're expanding substantially as well. And I would expect to see, frankly, a lot of activity in the green finance market for the extended stay, as the Americans would call it, service departments, part hotel space, over the course of the next year, because, of course, that space is expanding a lot.
Yeah.
And that requires finance. So
what would be the basic points that you would advise owners and operators in the service department space to access this green finance and ESG investment?
Well, if it's new build, right, then go over the top, right? So if you're thinking of doing BREEAM very good, do BREEAM excellent, and really and give back to the community. I mean, in a public way, right? Ensure that when you hire employees, etc., you go over, you ensure that it's a diverse group, etc., etc. You've got to tick all the boxes. A lot of this stuff people do in any case, but and that's great. But marketing it is going to be the key, right? You're going to market it. You've got to let people know, because if people know, your cost of finance will be lower, your ADRs will be higher, your occupancy will be higher. It's a virtuous circle, and there's a lot of money to be made around this. And the key driver of all this, is return on capital, right? Your return on capital will go up a lot if you do the right things, and you tell people you're doing the right things.
Yeah, great stuff. Thanks, Andrew. Andrew's going to be with us for a little while longer, but not until the end of the session. So if you do have any questions for him, please do submit them in the chat. Okay, let's move on to our next trend, which is the extended stay build to rent crossover. Now, I think there is an intriguing overlap between some of the more progressive build to rent operators whose main focus is offering residential rentals, which are their tenants' main address, and the mid to long stay element of the business travel market, which has traditionally gone for service departments. Fizzy Living, for example, has introduced minimum lengths of stay from as little as 3 months. It owns and operates 7 locations in and around London, and it's also partnered with a payment technology provider called Fore to offer tenants deposit-free renting. So this puts Fizzy Living's offer squarely in the project work and relocation arena, and I think we'll see a big move among build-to-rent players next year to focus on corporate tenants. Fizzy Living is also reportedly an acquisition target for US multifamily giant Greystar, and if that deal were to go ahead, it would give Fizzy Living access to a huge corporate travel client base. I also can't help thinking that the skill sets involved in managing service department buildings and build-to-rent assets are very similar, and I'm surprised that more companies haven't followed the example of Native, which began life as an apart hotel operator, but now has a far bigger build-to-rent presence than it does in the service department space. Native now has more than 3,500 build-to-rent units either under operation or in development. And with an increase in mixed-use projects, which include both build-to-rent and hospitality uses, it makes sense for an operator to be able to manage both. Of course, there are examples of this already. Cheval's 3 Keys property by Tower Bridge in London has separate wings with C1 and C3 planning consent, and it caters for both long-term residents and short-stay apart hotel business. And I think that's something we will be seeing more of, not just next year, but over the next few years. So on to our next trend, which is about consolidation in the agency space, and we're going to have a chat with Alex from Silverdor. Alex, welcome to you. Do you want to introduce yourself quickly?
Yes, thank you. Yeah, I'm Alex Neale. I've been at Silverdor for 12 years now. Silverdor, if you don't know who we are, is a wholly independent global service department agency. And by independent, we mean we don't own or manage any service department stock. We were established in 2000, and on the trend topic, we acquired Citybase in 2016 and the apartment service earlier this year. Since 2018, I've been the group head of partner relationships, and I take responsibility for Silverdor group brand's global supply chain of property operators.
Thanks, Alex. So, as you mentioned, in the last year or so, we've seen Silverdoor acquire the apartment service. We've also seen National Corporate Housing take on Bridge Street's agency business and several other additions. So, do you think this is the start of a big movement? Are we going to see more such deals in 2022?
It's a good question and hard to answer to some extent. I think it's likely that such processes have been accelerated in the last 18 to 24 months because of the pandemic. And but equally, I think it was inevitable that as the market matured, we'd see that agency market move towards fewer larger players, much like it has done already in the relocation market or the travel management market, or even in online travel agents. And I think it's pretty good for the customer as well, generally. You might argue that less choice could be a bad thing, but it's a much less complicated marketplace to understand now. And the stronger competition from fewer, better players leads to healthy market conditions where we all strive to improve ourselves. I'm not saying we're fighting like cats in the bag or anything, but at least everyone's forced to stay competitive. Mm-hmm. Many recent moves have involved an operator agent split, and as such were the ones the ones you highlighted. At Silverdoor, we've always been under the fundamental belief that agency and operator businesses don't fit together. They're two very complex and challenging business operations, and I know that there are different people with different opinions on this, and I'm sure maybe in the chat people will disagree with me here. But for us, we've always felt that of the hybrid examples out there, they're always really good at one side of the business, but or another side of the business, but rarely excellent at both. And at Silverdoor, we enjoy that position of being able to offer that unbiased service to clients without the pressures of keeping specific buildings fully occupied. Going back to your question about what happens in 2022, well, I think it really comes down to the performance of the sector and the path of the pandemic. We've always, we're having little wobbles here and there. If things get really wobbly, I think it's likely to force more people's hands and probably increase the process of consolidation, particularly if people are borrowing and investing aggressively. One of the reasons I've stayed with Silverdoor for 12 years is my confidence in the way it's run financially. And whilst you can't protect against everything, you want to give your clients and partners and colleagues every reassurance that finances are managed carefully. So all in all, it's probable that 22 won't see as much movement, I think, as past years, assuming we climb our way out of the pandemic, but deals will still keep happening. Mm.
And do you think this move towards fewer, bigger players will leave a space for some new entrants, maybe some smaller niche providers, perhaps?
I think it will be a challenge for them. I've said on previous webinars that it's easy to overcomplicate what is effectively a simple agency process to connect clients with apartments, and that should always be at the core of what an agency does. And in that sense, big or small, you ought to be able to achieve that. However, behind the scenes, the world demands a lot more to make that work than it ever has done before. So running a global agency, serving major brand clients or major multinational clients is an expensive undertaking. Your data has to be super secure. You're capturing a lot of sensitive corporate and private data. So you need to make sure you've got the best tools in cybersecurity, as well as quality training protocols for your teams. We undertake ISO 27001 information security management to give our clients that the confidence boost that we're doing everything right. But even the accreditation doesn't come cheap. Once your internal technology is strong and stable, you also need to invest in client-facing tech, and that has been a strong trend in 21 and probably will continue in 22, to provide technology that's attractive, usable, and genuinely adds value to your service proposition. But all of that either costs a lot of money to buy, or in our case, when we built something like the Orbi platform for our clients, it's a lot of expensive developer hours to build. And even your basic service quality needs to be just demonstrated to your new clients. And again, we invested in ISO for that, the 9001, to support our case, which is worthwhile, and I recommend it to anyone that can do it, but it is expensive in terms of both time and money. And as Joe discussed recently in your event last week, we're also seeing a significant increase in the attention of the exponentially growing sustainability drive. Again, we got an ISO for that, but there's so much more that needs to be done in that space, that it's going to need a significant investment from anyone. So it all feeds back to why there's been such consolidation. So you have to ask yourself what newer entrants can achieve those things, and you'll definitely need a fair amount of capital and probably a lot of experience too. Recent history suggests that technology disruptors are keen to develop the technology platform model in our sector, and of course they tick a couple of boxes there already in terms of the technology that they have. However, they are still they need to endorse the customer service demands as well. They need to accept the customer service demands, and I think if they don't invest in that, well, they have to invest in that to have success.
Yeah.
So the other entrants may be those pivoting from related markets. So you mentioned in the build to rent, moving into the service department space. I think it's the same with hotel and home sharing agencies investing in their ability to operate in our space too. So in those areas, I think there is access, but they're not smaller. There's not smaller entrants. I think it has to be a big entrant these days.
Yeah. Okay. And just quickly, Alex, where is Silverdor looking for potential acquisition targets? I understand there is an appetite for more, but they probably won't be in the UK. Is that right?
You want the juice. You want the juice.
Of course.
Well, we've been delighted with both of our acquisitions to date, and it's been incredibly hard work bringing them into the business, but it's rewarding and successful. And so it's for sure we haven't been put off by the experience. And to quickly reference my previous comments, we really want to stick to our pure agency model.
Mm-hmm.
So we'd only really consider what are either already pure agents, like we did with Citybase, or hybrids, where the acquisition allows for a split, as was the case when we acquired the apartment service and they split from room space.
Yeah. Yeah.
There's no optimal time to be looking for an opportunity, but and right now we're obviously investing a lot of time and effort and money into the apartment service, but you can't really choose when these opportunities arise, and they tend to come up when the other side needs it more than anything.
Yeah.
So we work hard to make sure we are in a position to consider opportunities as they happen. It's possible that we might be slightly more risk adverse when we're knee deep in other projects, but we'd always consider good options. And so you asked whereabouts in the world did you say? Did you say not the UK?
Yeah.
I think you're probably right there that it's unlikely to be UK based. Having two UK agencies acquired already, we're likely to focus on other strategic markets as our first priority. APAC has been a fast growing market for us, but agencies don't make up so much of the traditional landscape there. Equally, the apartment service was a good, strong competitor for us, which we've already acquired. So it's probably less likely there too. So I think if there's potential in EMEA, Central Europe, or even in the Middle East, or in the Americas, I think that's probably more likely, but impossible to say if and when. In short, I guess we're continually looking for the right fit, and we'll consider all acquisition opportunities as they present themselves.
Watch this space. Great stuff. Thank you, Alex. Some of the points that Alex picked up on there, I'm going to echo in our next trend, which is OTAs under pressure from alternative distribution players. So we may have seen a consolidation and a streamlining in the agency space, but there's quite a lot of other interesting stuff happening on the distribution front. So while the major OTAs such as Booking, Expedia, and even Airbnb are ramping up their efforts to win more business travel, they're facing competition from a diverse and growing range of alternative and specialist distribution players. Many service department operators have been quite reliant on OTAs, and a significant number also list short-term weekend inventory on Airbnb. But the pandemic has given operators a chance to take stock and review their distribution strategy. Some are focusing more on direct bookings, and others are looking for new channels. Eden is now using SiteMinder's platform to reach travelers in European markets through more than 400 distribution channels, including OTAs and vacation rental booking sites. And it's also made its own extended stay platform available as a distribution channel to other service department providers that use SiteMinder. Sonda has also launched on the GDS and has partnered with a number of high-profile TMCs and consortia, including Agencia and Trip Actions. One of the more intriguing developments has been the launch of JLL Short Stays, a booking platform offering business and leisure travellers professionally managed and flexible accommodation in the UK in a bid to compete with the major OTAs. Now, this is billed as a more professional alternative to Airbnb, and the platform already has more than 1,000 listings available in towns and cities across the UK. It offers fully serviced accommodation from anything between 3 nights and 12 months. Elsewhere in the distribution landscape, we've seen Homelike, a German-based online marketplace for 30+ day furnished apartment rentals, expand into the US, and a new wave of corporate housing solutions providers such as Alta Vita are gaining prominence in the market. I think there are also likely to be more distribution options for niche markets, such as London-based Equinox Travel, a TMC specialising in travel services for the music and entertainment business, which launched last month. Factor all these players in with the agents that we've already spoken about, and 2022 could see an unparalleled choice of distribution options for service department operators. So quite a few of the things we've already spoken about are all going to converge in our next Q&A with Joe Layton from CAP Worldwide. Hi, Joe, do you want to introduce yourself quickly?
Might help if I mute myself again, George, sorry. Yeah, hi everyone, I'm Joe, I'm from CAP Worldwide, and I'm delighted to be our ESG champion, chatting through some of the more challenging areas that I know that Andrew's already discussed. We're thankful to have got through the pandemic. We were a startup about 8 months before pandemic hit. And we are a diverse company, so we are a certified women-owned company. And delighted to chat with you today, George.
Thanks, Jo. Nice to see you. Okay, so Andrew has spoken about the green finance in terms of operators and developers accessing it to fund new properties or to operate their companies. We're going to talk a bit about how the ESG agenda is translating into what corporate clients are demanding from operators and agents on a day-to-day basis. So Joe, how do you see corporate travel buyers' ESG related demands growing over the next year when it comes to accommodation providers?
Yeah, and I think it's fascinating what Andrew was saying. However, Andrew, if it's anyone in the service department community, they might be sitting there thinking, can someone translate what you've just said, because it was such high level and such incredible information. I think myself and Alex probably sitting a little bit back and listening to the green finance. But George, from our perspective, we all know the COP26 agenda is leading the drive now for corporate companies moving into 2022. It has definitely, exactly as Andrew said, given focus to the CEOs and the CFOs of the large corporates, with green finance reporting requirements coming to play. And I think, Andrew, it's right to say they're coming into much further play in 2023 and 2024. But for instance, at the moment, the UK is about to follow the EU with taxonomy requirements, which is basically where we will be creating a global baseline for sustainability reporting. And that's going to make reporting of companies' efforts in year-end reports, which is what Andrew's alluding to, in the world of sustainability, I think is probably a higher agenda point as the company's financial reporting. It's definitely, sustainability is here, it's here to stay, it's an absolute agenda point. And with the green finance roadmap, which is asking corporates to disclose their percentage revenue, and the reason why I'm telling you this, it will make sense when I get to explain to you, but their percentage of revenue, either in OPEX, CAPEX, and anything that's related to the green criteria, they're going to be looking for people to use to create the transition plans and stewardship across their businesses. Which is going to get picked up by the travel buyers and by procurement teams in travel, definitely, because we sit across the key P&L areas that negatively impact on emissions, sadly, including corporate real estate services, which in a lot of companies is where the corporate accommodation travel sits. So we know this is going to be a massive high agenda point for the travel buyers as they sit down and receive the plans for next year that trickle down through their organisations. So this is a high awareness for us in the second tier, and I know Alex is going to agree with me here, is such a high awareness in the second tier sustainability. So as well as their own company sustainability, they're now going to be, anyone working with the travel team or in procurement is going to be asked to support giving that information back, and that's where we as an agent, along with companies like Silverdor, come in. So travel buyers are going to rely on us now to provide this support when the baton's been passed to them, and we're going to need to report on the spend in the sector and how we manage our supply chains moving forward, especially 2022, 2023. They are very aware, their CEOs and CFOs have identified their spend as creating emissions, which is what is causing higher scrutiny of business trips. For instance, the length and frequency of trips, are they business critical? Should there be more approval processes? CEOs and CFOs became accidental savers, didn't they, over the last couple of years, last 2 years especially. And because of the pandemic, they're now going to be reluctant to return back to where they were in 2019. They don't want to have the same emissions. So they're moving slowly forward in business travel, not so slowly, however, in relocation. And I think Alex would agree with me there. Relocation travel continued to be quite buoyant. Business travel disappeared completely across some major markets. But with buildings, George, with buildings and travel being two of the highest carbon challenges for our stakeholders in these businesses, the supply chain is going to become an agenda point for their green criteria.
Yeah.
Agents, platforms, aggregators, all of the above that you just went through pre our chat, and we are the agent in this discussion, but they need to take the responsibility and, importantly, the accountability. And that's where, as an agent, is probably better than a platform, because we can actually give back that information and we understand what you're looking for. And we need to, we need to endeavour to provide sustainable options to the buyer or to the traveller wherever possible and wherever appropriate. Yeah. But so that's obviously going to change a lot.
As I understand it at the moment, Joe, then a travel buyer will come to you with a tick list of, we'll use the term sustainable, a sustainable wish list,
Yep.
and then the onus is on you to vet your accommodation providers to make sure that they meet those criteria. Is that right?
Yeah, 100%, 100%. When you think about it, our role in ensuring that we meet these buyer needs now is in helping to manage their spend, their stakeholders and their travellers. This is going to remain, we've always done that, and that remains now critical for us all in 2022. But how does that work for us is quite interesting. This is where, and I agree 100%, and it's sad that I have to say that I agree 100% with Alex, who's one of my biggest competitors, obviously, but this is 100% where accurate reporting, great partnerships, excellent collaborations is now required between agents and operators across our sector to support sustainable development. We, the third parties and the agents, are really the conduit to get your green credentials, the operator green credentials in front of the buyer and traveller. We need to be educated by the operators now as to what they're doing and how they're doing it. So agreeing 100% with what Andrew was saying about, you know, the marketing is important, but actually I would rather call it education and information rather than marketing, because I think everyone's been talking about the greenwashing, so that's not an area we want to go into. But at the moment, what I would say as well is, and I said this last week, George, at the moment, traveller choice trumps sustainability. So travellers are just choosing, not necessarily asking too much about sustainability. Mm-hmm. But this will not be the case in the future when every employee has a stake in the company's deployment of green, their personal agendas, and then global goals that have been shared. And I know that last week, Alex and I were lucky enough to take part in a sustainable development discussion focused around the UN and 2021 goals, 17 goals, where we need to provide commitment globally and together towards that. So that's going to be really, really interesting for us as we move forward.
Mm-hmm. And presumably these, the travel buyers wish list is only going to get longer as ESG requirements become stricter. Mm-hmm. So in your experience, how far down the road is the service department sector generally in responding to what is needed? Is there still a lot of work to do?
Oh God, yes. I think very short answer is sustainability, George, is where we were 30 years ago in technology. I've said that before, and I'm going to keep saying is sustainability needs to become part of our DNA. And there's going to be a lot of learnings for us as along that route. It's an interesting route to travel, but it's one that we're all on at the moment. And how we report on ESG has not yet been truly defined, and that's exactly what Andrew was referring to. There's definitely some naivety across our sector with regards to what even economic, social, and governance means, and predominantly that's because we're a relatively small industry. For instance, how many of the service department companies or operators are listed, and Andrew went through quite a few of those, didn't he? And knowledge and understanding of how we will future-proof our environmental impact has been an agenda point for many, many years, previously known as CSR, corporate social responsibility. But what is new is that this is now a universal agenda for us. And with the scale and ambition to work in collaborative partnerships, we need to work together with all countries and stakeholders and agents and operators to basically implement these incredible plans that are going to hit us over the next 2 to 3 years. For me, personally, I think that the biggest emission, and I'm sure that everyone will agree with this, is in our buildings that we have in our industry. And don't underestimate the risk of driving aesthetics over sustainability and infrastructure. For operators, for a lot of our operators that Alex and I use in the industry, if you're leasing units, this is a challenge as you've got less influence over your building management and therefore your emissions. Owners of buildings and investing in future infrastructure is the key to reducing emissions. We all know writing off emissions is a stopgap. The real need is to make positive reductions and changes. Definitely.
And when you're vetting accommodation providers, Joe, presumably the environmental performance is probably the easiest one for you to quantify. There are all these schemes that Andrew mentioned earlier, BREEAM and LEED and these things. So you can kind of, it's not too much of a struggle to find out how a building is functioning. But presumably now that the ESG wish list also goes further and looks at things like employment practices, equality and diversity, this kind of thing. So how do you go about measuring an operator's performance in that field? That must be much harder to quantify.
Yeah, it absolutely is. And of course, I was saying last week that I had a meeting with a large corporate bank, and one of the biggest things that they brought up as a major issue, and it hits the S in ESG, was they were asking how the impact is of how we manage our policies and processes through, for instance, modern slavery. And modern slavery is not something that we would think that would be hitting us in 2022. It's sort of something that you've got a policy for. Everyone checks to make sure that their suppliers are doing the right thing. But the reason why it's come up for us most recently is because of the number of, say, for instance, in the UK, the number of refugees that are now entering the UK community, and they're absolutely that they could be used as cheap media, as cheap labour, and with the current issues around staffing. So from a corporate perspective, our understanding of these subjects, such as either green taxonomy, as discussed by Andrew, and also modern slavery, is going to be required more by the boards, even of small companies, in the next 18 months or so. I absolutely agree as well. I'm going to go back to what Alex said. Another key point as an agent is that we have responsibility to kind of mediate, and I'm going to say, in the increasing post-COVID guest issues that we're experiencing as an agent at the moment. We have multiple times now where we're struggling to achieve the service levels of 2019 from an operational perspective, i.e. there's many lower staffing levels that is happening within our operated products that we're booking into, and because of many things, you know, people couldn't invest as much as they have because they've had cash flow issues, or they've got dilapidations in their unit which costs them a lot of money to put right, or even just increasing their personnel. Currently they don't have the cash flow maybe to be able to do that as quickly. So where we have people that are so much more concerned about travel, they're actually sometimes arriving into operated products that are struggling to reach those levels of 2019 of support and comfort for those travellers. So, you know, from my perspective, I really want those operators to get back up to a level where they are feeling that they can really, really focus on the basics that they're so brilliant at, which is looking after our guests, making sure the products are clean, safe and legal for us as well. So, you know, those things are so important, but I do think a back to basics mentality is definitely required for a lot of companies in 2022. So wipe off what you knew in 2019 and focus on really making sure these customers want to come back and stay in these incredible extended stay options.
Yeah, and with regards to the sustainability side of it, it's not something that you can sidestep now. It's absolutely going to be crucial to the survival of your business. Is adapting the agreed. Yeah.
George, I have to step out now, I'm afraid. But thank you very much, everybody. And
thanks, Andrew.
Anybody got anything they want to talk to me about, then contact me directly. I'd be delighted to respond and engage in a conversation.
Thanks, Andrew. There's a link to download your green finance paper in the chat there. So if anybody wants to do that, we're going to actually leave the session open for a couple of minutes when we've finished, because there's quite a lot of info in the chat, so people can have a look at that and they can download your paper there. So
thank you very much indeed.
Thanks, Andrew. See you soon. And thanks, Joe, for your segment. There's some fascinating stuff there. So those are our 6 trends for next year. I'm just going to show a couple of slides before we wrap up. We will be putting on some live in-person events, starting with Recharge in March in Paris, which is a great little event. We've got a couple of award schemes that I expect most of you are familiar with, the Service Department Awards and the Shorties. And we'll also be hosting the second edition of our Urban Living Festival, which we launched at Tobacco Dock in London earlier this year. You can see links to get more information about all those events in the chat. As I said, this is the last Service Department News webinar of this year. We'll be back on February the 17th, when we'll be having an in-depth look at the investment landscape for the extended stay sector. And if you'd like to sign up for that, again, the link is in the chat. If you're interested in getting involved in any of our events, whether it's as a sponsor, an exhibitor, a speaker, please do get in touch with Katie, whose contact details are on the screen and also in the chat. So thanks for watching, everyone. Have a great Christmas or Hanukkah or whatever your particular holiday is. It's been a tough year for the sector in general, but we're all still in here. You know, I think next year, as we've spoken about, there's going to be a lot of interesting stuff happening. Thanks to IMS and to AHV for sponsoring today. Thanks to Joe, to Alex and Andrew for their contributions. And thank you all for your time. We'll see you next year. As I said, we're going to leave the session open for a couple of minutes so you can take notice of all the information that's in the chat. And we'll see you back in 2022. Thanks, everyone. Bye-bye.